Hello everyone, this is Ben with Income Options Trading, and in today's video I'm going to go over a strategy that I have not done a video on yet, but that I've done in my portfolio for quite some time now. I call it the modified ratio Superbull in the S&P 500. So just a quick disclaimer here that I am not a financial advisor and this is not financial advice. Options trading involves a lot of risk, and you should know what you're doing before you put on any options trade. So the modified ratio Superbull is obviously a modified version of the ratio Superbull. I've done videos on both the Superbull strategy and the ratio Superbull strategy. So if you have not checked those out yet, I will put a link in the description below. I recommend you watch the Superbull trade video first, and then the ratio Superbull trade after that. So for this trade, I'm going to start out in the SPY, which is the S&P 500 ETF. And I'm going to start out with how I first started the strategy and move on to how I trade it now. So the trade actually started as a Superbull trade instead of a ratio Superbull trade. And I'm going to show you how I set that up first. And this is a strategy that you can use moving forward as well if you don't like the modified ratio Superbull version that I do. I think both are good trades. So typically I like to go out to the 60 to 70 or 60 to 90 days to expiration, which is the November 19th in this case. And you can see I have a 444 hedge on, another trade that I have a video on. This is going to be kind of similar, except it'll be the bullish version of this. So just a little background first. My portfolio, I like to keep a net negative beta weighted delta all the time, meaning I am net short the market. The reason I do that is I like to sell premium, and selling premium means you are negative vega, meaning that vol expansion hurts my portfolio. I play for volatility contraction, meaning the VIX or the volatility, which is /VX or VIX, I want it to go down. And when it goes up like it did today, short option strategies or options in general get more expensive because the market gets scared. So the VIX index, you can also call it the fear index. And with the S&P 500 and the NASDAQ or the Russell or the Dow, the market in general, when we have down days like we did today, the market gets scared. So typically when the market goes down, volatility goes up. So having a net short delta in my portfolio hedges me against this volatility expansion. So today I lost money on my short options, but I made money from my short delta. So net today, I was up a little bit. If you want to hear more about that, let me know in the comments, and I can talk more about the reasoning behind the short delta and how I determine how much delta is ideal. And I guess ideal is a bad word. How much short delta is an acceptable range for me, I should say. All right, so with that said, I like to have a net short delta portfolio. So this trade here, the modified ratio Superbull, is one of the ways that I have some net positive delta in my portfolio so that I can make money from some of my positions when the market goes up, which it has been going up ever since the COVID crash, every single day it seems like. All right, so the Superbull trade, if you haven't already, I recommend you watch my video from before. I'll go through a quick recap here. The Superbull is buying a call spread and selling a put to finance it. So in this case, if I did a call it a 10-point wide call spread, and I just picked the 49 delta. No particular reason. I would choose to sell a put for the same price, so I'm just looking at the credit here, and I want this closer to 0, but still a net credit. So in this case, I could go all the way down. I'll sell the 410 put. So I could sell the 410 put, and I could buy the 458 call spread, and I would take in 22 cents of credit. So I'm using Tastyworks here. If I go and click curve and click analysis, I'm going to take off my other positions and just put on this trade here so you can see what this looks like. So the Superbull here, I don't lose until I get down to my 410 put. There is a glitch with the Tastyworks platform since the last update, and this was brought up on air today, but it's off by 5 points on some tickers. So this is an instance where we're off by 5. So you can see that the stock here, which is determined by this flag, is around the 450 mark. But if you look up here, the SPY is actually at 445. So that's one confusing thing. Unfortunately, with this, everything is off by 5 points. So I apologize for that, but that is a Tastyworks issue, and they're aware of that, and hopefully that the fix will be pushed out soon. So the 415 here is actually the 410, which is my short put. So the 410 put here points up to 415 here, but this should actually be 410. So at 410 is where I start to lose money, and my risk in this trade is that I get long 100 shares at the 410 mark. And then on the upside, you can see here I keep my 22-cent credit, and then starting at my 458 long call spread, that's where I can make up to $10 of extra profit here. So if you look at my P&L expiry here, which is 1,022, that is my max profit if the S&P 500 ETF here, SPY, goes above 458 on expiration. So that is the Superbull trade. So the way I started out the Superbull in the S&P 500, I first bought the at the money call, and then what I did was I sold the call strike that was half of the premium. So in this case, let's call the 446 strike, let's say I can get for 1180. So half of 1180 is what I want to find here. And if you don't have a calculator or you're not good at math, one way you can look at this is if I take off this put here, basically I want this debit to be about the same debit as this price here. So in this case, it's going to be around the 575 or 590 mark, excuse me. So in this case, there is not one for exactly 590. So you could either go to the 456 or the 457 strike. And since I did the 446, I'll just pick the 456. So this is a 10-point wide spread. So then I need to find a put that I can sell for 567 to pay for this. So I'm going to go up here, looking for 567. I could go with the 411, and that would be right at break even. I'd probably have to pay a small debit. So I'll go to the 412. I'd take in 12 cents. If I go back to the analysis page here, you can see it's the same sort of setup as the previous Superbull. So this is a way you can get long the market either at lower prices. So in this case would be 412. Anything below 412 is where I risk getting long 100 shares of SPY, and above it I can make up to $1,000 extra. So this is what I first did at first. And like I said, the risk is your short put, and your short put runs the trade, meaning that this is going to move the quickest. So if the market falls, you're going to lose more on your short put than you're going to lose on your call spread. So I thought I would like to have a way where I can get rid of this short put and have my long call spread on afterwards. So you can do that in two ways. First way is to sell a put that is double this price. So in this case, it would be just under $12. And in that case, if I went all the way up $12, it would just be under, would be the 442. So if I sold this 442 and I got rid of the short put at 50% profit, I would then have this long call on for free. So if we look at the curve analysis again, you can see that now my risk is anything below 442. For me, I wasn't very comfortable with having that risk so close to at the money. So what I did instead is I turned this into a ratio Superbull. And if you recall, a ratio Superbull is where you sell two puts instead of one, and you sell the two puts to finance this call spread. So in this case, we would want two puts, which when totaled together gets me 567. So we're looking at about 290. So if we go all the way down 290, sell two of those, you can see my net credit now is 25 cents. So in this case, if we look at the curve analysis, now I don't lose money at expiration until the 380 mark. Before it was the 410. So selling two puts pushes that break even way further down. And what do we give up for that? Well, now our risk is getting long 200 shares at 380 instead of 100 shares. So you essentially double your notional exposure, but you push down your break even. And in this case, you would want to keep your put on the whole time so that you make money at expiration if the stock goes down a little bit. So that's the ratio Superbull. So instead, I did a modified version where I start with the Superbull version. So I'm looking for the short put that I can sell for 567. So I'll go to the 412. And instead of selling one, I'm going to sell two. So now I take in a credit of 591. My risk is getting long 200 shares at 412. So that is my notional value exposure. So that's my risk. But what can I do now instead? Oops. Now I can set a GTC, which is a good till canceled order, for 50% profit on this 412 put. Meaning if I sell it for 590, maybe I want to try to buy it back for say 290, and that would leave me with a small profit, and that would get rid of my short put. So if I were able to sell that at 50% profit, then I would have this call spread on for free, because the profit on my short put finance the price of this call spread. And then depending on how far away it is yet, typically the short put takes 2 to 3 weeks before it comes off at 50% profit most of the time. So if it's, call it 20 days, and this is a 70-day expiration, that means I have 50 days where I have a long call spread, $10 wide, that I can just leave on and take off whenever I want. So right now I only have one in this account. I have a couple different accounts, but I only have one ratio Superbull that I put on a while back, and you can see I put it on when SPY was around 431, and with today's down move, it's getting a little bit closer to my short strike, but I could sell it out. Here's my working order. I could sell it out for $872, so that would be $872 of pure profit because I already took off my short 2 puts for this modified ratio Superbull. And these other trades here are the 444 hedge, which, like I mentioned, I also have a video on you can watch as well. So I also modified this a little bit further, and this is similar to the 444 hedge. So I do recommend you listen to that video too as well to understand where I'm coming from here. But what I essentially do is I use MES, which is the micro E-mini S&P 500 futures, for the short puts instead of SPY. So if I go back here to the 567 again, the 412 strike, and I sell 2 puts, this buying power is $11,700 to put this on. And that's quite a bit of buying power for this type of position if I don't really intend on taking the stock. So if the market were to move, if the market were to move down, what I would do with this short call, or the short put, I would move this out in time and try to drop it further. So maybe it's been a couple weeks and the market keeps dropping. I would try to roll this 412 put in November. Maybe I can move it to the 400 mark in December for a net credit. If I could do that, then I would just keep rolling down the puts, and eventually, don't know when, but eventually the market should rebound, and I won't have to take the shares of SPY. But when you're putting this on, you should have the account or the notional value of your account should be able to handle the notional value of the 200 shares of SPY. But back to my original point, I didn't want to use up this 11,700 selling 2 puts in SPY. So what I did instead was I went into MES and I can sell 4 puts in here, and that is the same notional value as 2 puts in SPY, because MES is half the size of SPY options, meaning that one MES option is 50 deltas in SPY. So if I go back to SPY here, hopefully this makes sense. Please leave me any comments if it doesn't, but if we go back into here and I get rid of these short puts, so again, we're at this $567 debit, which is a max loss of $567. So we're going to want to sell 4 puts, which when combined takes in double this amount, so that when I take off the short puts at 50%, it covers this cost. So I'm just going to round up to $600. So 600 times 2 is $1,200. So now we're going to go into MES, and we're going to look to sell 4 puts where I can get $1,200 in total credit. So I'm type in /MES, and I'm going to go into the November 19th. I'm just going to start out and sell 4 puts. Now, if you haven't done MES before, the multiplier for MES options is a little bit different than in SPY. So in equity options like SPY, the multiplier is 100, meaning if you took in $93.25 in credit, it would actually be $9,325. But in MES, the multiplier is 5. So in this case, you would take 93.25 times 5, and that would be your credit per contract. I sold 4, so you multiply it by 4, so it would end up being 93.25 times 5, which is the multiplier, times 4, which is the number of contracts, and you would get 1865 if you were to punch that into your calculator. So I'm just going to look at this max profit here, and I want this to be about $1,200. So I'm just going to keep moving this up until I get to about $1,200. Or I'm just going to round up to the nearest 50. So I would sell the 41.50 strike, and I would get $12.45 in profit. And then after I put this through, meaning I sold these 4 puts in MES, and at the same time, if I go back to SPY, I would route this order for this call spread. I would have a cross-product modified ratio Superbull, where once I can take off these short puts at 50%, then I have a long call spread in SPY for free. So that is the modified ratio Superbull trade that I do, and I do it cross products, meaning that I do it in SPY and MES. You can see here that my MES, because of span margin, the buying power reduction is only 1,800. So it's about 10 times more efficient, or 10 times as leveraged as SPY. So you don't want to go overboard and sell too many of these, because your risk is still getting long, in this case, 4 MES futures contracts, which is the equivalent of 200 shares of SPY. So, and with SPY at 445, 100 shares would be $44,000. So 200 shares would be $90,000 of notional value. So you don't want to go overboard with selling these MES short puts, but it's a good way to use less of your capital if you don't have any intention of taking the stock, and you know how to roll puts and maneuver yourself as the market drops. But if the market goes up, like I said, you can take this off, and then you have no more risk in the position, and you have a long call spread on that you can take off at any time. I usually wait until the near expiration. If we go back to my positions tab here, you can see, so this was a $10 widespread. I had a GTC order in for $9.80, which is pretty close to full profit. And you can do whatever you want here. So if it's a $10 wide, maybe you want $9 or $900 in profit in the end. You can see with 7 days ago, we are totally in the money with this spread. We are 4 points above the short call, and we're still only at 870. So we'll have to see how the market behaves next week for this particular position, but you can take it off whenever you'd like. So that is the ratio Superbull in the S&P 500. I've been doing this for probably a year now, and it's been one of my most profitable positions against my short delta. If you have any questions, please leave them in the comments below. You can also hit the like button if you like this video. I do have a Discord. If you join the gold membership on my page, if you hit the join button right below this video, it's $10 a month. I post all my trades on there. I have some tracking spreadsheets that show all my open trades and closed trades and my P&L, and I have some extra videos on there on various strategies, and I answer any questions that people have in real time each day when the market is open. So if you think that you'd find value in that, go ahead and join. I would appreciate it. Otherwise, I will see you next time. Thanks for watching.